Let's travel back to 1999, an era where everyone was crazy optimistic. Back then, connecting to the internet sounded like a robot screaming in a blender. That was the start of the dot-com era, a time when it felt like the stock market had no rules, like gravity just didn't exist. Picture this. You're an ambitious business owner in the late 90s, and you want to be a millionaire. You didn't need a product, any customers, or even a clue how to run a profitable business. All you needed was a name. If your company was called Bob's Shoe Store, you were just some guy selling loafers. But if you renamed it Shoes.com, investment banks like Goldman Sachs or Morgan Stanley would be knocking down your door before lunch, begging to take you public.
The day that we moved into our offices, we started getting calls from investment bankers inquiring as to what our thoughts were on raising additional capital or going public. This is before we had furniture. Literally, we had boxes for our desks, and we were sitting on the floor. There was that level of buzz in the overall public markets at the time. And you laugh about it. You're sitting there with your box going, should I buy furniture or should I talk to the investment banker about going public?
There was this collective hallucination that the old economy was dead and the new economy had arrived. Traditional stuff like price-to-earnings ratios, people called that boomer logic. Investment banks were basically acting like hype men at a club. They would package these low-value, zero-revenue companies and sell them to retail investors, like a grandma or the local plumber, as if they were selling tickets to the fountain of youth. Why? Because the fees were insane. An investment bank could make 20 million to 50 million just for taking a shoddy startup public. They would set the initial price, and on the first day of trading, the stock would pop, jumping 200, 300, or 500%.
Everyone saw Netscape's revenues increasing dramatically. Everyone saw that this was a technology that was going to change every single business.
This is affecting hundreds of millions of people already. This is going to affect billions of people. It's going to change economics.
Out in Silicon Valley, kids who used to be called nerds suddenly became millionaires overnight. One day they were working out of their garages. The next, they were rolling in cash, all from the red-hot tech boom.
So around Mardi Gras time, I invited about 200, 300 people, got a shuttle bus to take them all the way up to the hill, to the estate. Everyone had costumes. For people that didn't have costumes, we had a room full of costumes. DJ in one room, a steel drum band in the carport. It was a wild night.
I would go out and do a pitch and literally walk out of the pitch with a $40,000 check, with a $100,000 check. There's just so much money being thrown around this thing. I was like, I can just put up a net and just catch, just a little bit.
The stock market mania had everyone hyped up. The new century felt like it was opening the door to a whole new economy, and everyone was 100% sure stocks could only go up. These new startups didn't need old school business sense. As long as their stock prices kept rising, the future looked bright. What everyone wanted wasn't profits. They wanted bigger stories and more attention. Piles and piles of cash were just thrown into advertising. At the 2000 Super Bowl, 17 internet companies bought ads, spending almost $2 million on average for a single 30-second spot. Altogether, they burned through over $44 million, total reckless splurging, right at the height of the tech bubble hype. Take Pets.com. This is a perfect example of the era. Basically, their whole business plan was, we'll ship 50 pounds of dog food to your door. We'll actually pay more for shipping than the food itself costs, and then just make up the loss with marketing. It was crazy, and they spent $1.2 million on a Super Bowl ad featuring a sock puppet. In 1999 alone, they lost a staggering $147 million, with marketing costs running a full 20 times higher than their actual revenue. The company went from IPO to total bankruptcy in about 9 months, but before it blew up, everyone was cheering.
I'm not normally described as perverse, but you've got to be perverse to say the market's going to crash.
And the rest, as they say, is history. In April 2000, tech stocks crashed. Billions and billions of dollars in shares were sold all at once, causing a massive panic. As tech companies' values disappeared, regular investors watched their money vanish into thin air.
Now, I had bought stock in Sun, Selectron, Yahoo. I'd done my research. I didn't think I was stupid. All of these stocks in a year or two or more prior to that had a positive line on their graph charts going up. I said, how bad surely this cannot happen on all of these companies. Every single one tanked.
Now let's take a look at today's AI market. It's changing non-stop and everyone's terrified of missing out. Every company that ever mentions AI has seen explosive growth. Does any of this sound familiar?
I think this is going to be an extraordinarily powerful technology. I think it's going to reshape significant parts of the way we live and work and that our economy runs.
The AI is the biggest technical thing ever in my lifetime. I mean, it is so profound.
And actually, my prediction is we will actually make so many robots and AI that they will actually saturate all human needs.
We're right in the middle of the AI gold rush, and the fever dreams of 1999 are starting to creep into 2026. If you look at earnings calls for the S&P 500 companies, the word AI is mentioned more often than profit or growth. Tons of money has been poured into building more powerful AI models. But when it comes to profits, nobody has a real answer.
The company's still losing money, and obviously you're building. What is the path to profitability? When do you see the lines cross, if you will?
It seems to me like the right thing to do is to just keep investing in compute and continuing to grow.
Lots of companies saw their stock prices jump big time once they said they were getting into AI. Microsoft's $10 billion deal with OpenAI, plus putting GPT into Bing and Office, pushed their stock up 56% in just 1 year. Meta's launch of Llama 3 pushed its shares up by 50% in 2024, and Google topped all the Magnificent Seven with a 55% gain in 2025 thanks to Gemini. And this market heat has trickled down to everyone. We got Nvidia stock absolutely over the roof right now. We got people following hard on AI infrastructure stocks, scrambling to get in on the action. And not too long ago, Chinese tech giant Tencent even set up a booth downstairs, giving people free help installing OpenClaw, this super popular personal AI agent that everyone's talking about. We've also seen all kinds of AI startups taking over every industry. AI is everywhere, in AI doctors, AI fridges, AI bracelets, even personalized AI astrology services. Startups are now raising $100 million seed rounds before they even launch a website, just because their founders worked at top AI labs like Google and OpenAI. In 2025 to 26, only about 5 to 10% of AI startups in Silicon Valley actually have their own foundation models that they can train independently with full ownership. Startups that just rely on rented models are called AI wrappers. Some even say they don't have any real technical advantages at all. So it feels like the sock puppet energy is back. Only this time, it's not a pet food site. It's AI startups built on maybe fake demand. But this time, it's actually different. I know every time someone says these 4 words, they usually end up paying for it. But when you compare today to the dot-com boom, it's a whole different ballgame. In fact, the fallout from the AI crisis could be way worse than it was in 2000. The first difference is that AI isn't some blind, crazy hype like the dot-com era was in 2000. Back then, the internet infrastructure was still primitive. The internet was just a promise. Most people had dial-up. You couldn't even stream a movie. And stock prices were based on totally inflated values. But today, AI is built on a fully mature, high-speed network with billions of smartphones already in people's hands. Today's AI companies are valued much more clearly based on their tech, market share, and potential revenue. We'll probably never see the mindless, nationwide hype like the late 90s again. But even if the mindless investment hype doesn't repeat, it doesn't mean the AI bubble stock market crisis will be any less shocking than 2000. And that brings us to the second key difference: who's spending the money and who's really in this game. Back in '99, the so-called tech giants were just shaky startups burning through VC cash. Fast forward to 26, the leaders of the AI revolution are the Magnificent Seven: Microsoft, Apple, Google, Amazon, Meta, Nvidia, and Tesla. And the concentration is crazy. In 2000, the top 7 companies made up only 1/5 of the S&P 500. Today, the Mag 7 alone make up about 1/3. These are not sock puppet companies. They're the most profitable, cash-rich companies in human history. I bet most of you have seen this iconic chart before. These AI companies have successfully painted a picture of a perfect, self-sustaining cycle by pouring billions into each other and signing billion-dollar partnerships. But if one link in this cycle breaks, or people wake up to the fact that AI companies are way too slow to turn a profit, they'll say, wait a second, these values don't make sense. I'm no longer buying into this. And that could be the moment the AI bubble bursts. Here is one possible scenario. SpaceX is getting ready to go public with an expected IPO raise of over $75 billion. That's roughly 2.5 times the size of Saudi Aramco's IPO. In fact, this one IPO alone will raise more money than all US IPOs combined in 2025. Institutions that want in on the SpaceX IPO will probably sell off big tech stocks like Nvidia, Microsoft, and Google. The smaller tech stocks are even riskier. Their liquidity could dry up completely. If all the liquidity gets sucked out of the tech sector, it's likely that we will face a major market crash. Once that happens, with so much money concentrated in top tech and AI companies, any investor owning stocks or index funds won't be able to avoid the massive shift. The third difference is that the impact of the dot-com era isn't even in the same league as AI. The internet in 2000 was a vertical. It was its own separate sector. But AI is a horizontal technology. It's more like electricity or the steam engine. Trillions of dollars have been poured into data centers, chip factories, and power infrastructure. The future of economic growth is basically tied to AI's development. And it's not just tech companies. It's helping pharmaceutical companies discover life-saving drugs. It's helping every business process millions of documents in seconds. So here's the thing. When the 2000 dot-com bubble started to burst, tech stocks crashed hard, but sectors like retail and energy didn't fall nearly as much. They held up pretty well during the bear market. But today, AI is everywhere, in every industry. If this bubble deflates, it won't just hit the tech sector. It will cause a market-wide drop. So, here's a question on everyone's mind. When will the crash hit? Is the Nasdaq going to crash 80% and I'm gonna lose most of my money in the stock market? Right now, big investors like Warren Buffett and Peter Thiel are sitting on tons of cash, and a lot of people think they're waiting for a market crash. But there's a saying that right now, AI is a rigid bubble. Back in 2000, when the money ran out, tech companies simply collapsed. But today, the major players in the AI market are too big to fail. Even if AI hype dies down tomorrow, Google, Amazon, and Microsoft will still own the world's largest search, software, and logistic platforms. And because AI technology has evolved into a cornerstone of strategic competition between nations, investors believe that the market can't easily drop, fueled by faith in government support, the central bank put, and regular people buying index funds through their 401ks. I asked several major AI models if they think the AI bubble will burst in this year. Most of them said the 2000-style crash is really unlikely, but there's a good chance we'll see a valuation correction this year. GPT said the chance of a full market crash in 2026 is around 15 to 30%, while a mild correction is way more likely, about 30 to 50%. Gemini said that retail investors see just a 16.7% chance of an AI market crash in 2026, but institutions like Capital Economics are far more pessimistic, warning that if interest rates remain elevated, the chance of a bearish economic outcome jumps to 80%. Meanwhile, Korean reported that an AI chatbot trained on Redalio's ideas points to a 65 to 75% chance of a big correction in AI stocks this year. So you might be thinking, I'm just an average person, not a Silicon Valley CEO, maybe just starting out as an investor. What should I do to better protect my money in this AI bubble, and even make profit from it? First off, embrace long-termism. You might need to shift your mindset and become a long-term investor. This isn't just another short-term hype. AI is a generational shift, a technological revolution that will reshape the entire global economy. So don't be scared of the bubble. Instead, get ready to grab the huge, long-term opportunities AI will bring over the next decade and beyond, just like the internet revolution did. Second, use AI to build new income streams. Everyone's worried that AI will take their job or income, but don't panic just yet. Instead, start using AI to make money right now. The best part about today's AI is that you don't have to be a coder or a tech expert to benefit from it. It has opened the door for regular people to create content, start businesses, and monetize their skills like never before. Trust me, there's always a new AI-powered opportunity that's perfect for you. Third, don't go all in on AI right now. It's not the best time to bet most of your money on AI. The best companies will make it through the cycle and survive the crisis, but before that, the market will go through a painful bubble bursting phase. If you go all in, you get crushed in the correction. Keep your AI investments at a reasonable percentage, stay diversified, and avoid putting your entire portfolio at risk. Next, hold on to your cash and ditch leverage. Right now, it's smart to keep cash on hand, and under no circumstances should you use leverage to trade stocks. Don't let media hype or the fear of missing out trick you into making reckless decisions. Cash keeps you safe during a crash and gives you the power to buy in when everyone else is selling. Finally, buy the good and buy the dip. Stay far away from AI hype stocks that have no real business or earnings. They will get wiped out when the bubble pops. Instead, do your research now to find high-quality companies, those with real competitive advantages and solid earnings. Then be patient, wait for the market to correct, and buy those quality companies at a great discount during the dip. When the dot-com crash hit, it was terrifying, but it wasn't the end of the internet. Valuable companies not only survived, they conquered the world. Imagine buying Amazon at the dot-com low and holding on. You'll be retired wealthy with returns hundreds of times your initial investment. The same will likely happen with this AI bubble. The foundational technology of AI is here to stay, and it's only starting to change the world. So just stay safe and excited. Make sure to subscribe, and I'll see you in the next video.